Tamakaze here with a video on credit spreads and how you can take advantage of theta and be the casino. Let's jump right into it. Why would you want to play credit spreads? There's some major advantage of credit spreads that you don't get in normal options like just playing calls or puts. One of the big advantage is you have low risk. So you're doing these in high percentage profit situations with capped losses and capped profits. This allows you to strategically play your position unlike some other positions. These are low risk, they have max losses, they require less monitoring, and they can be more versatile with the credit spread because you can buy and sell parts of the legs as you need. And the most important reason you're going to play a credit spread is because now, instead of time being against you, aka theta, now time is your friend. So the big thing that a credit spread allows you to do is take advantage of sideways movement, where normally with a normal option, sideways movement is going to hurt you. In this case, it's going to be your friend. There are some disadvantages. The cap profit potential. Your profit is exactly what you sell the credit spread for. You cannot make more than that. You do get potentially double commission fees as well because you're doing two options for one play. So if you're on a high commission platform, this may not potentially be for you. So what are the main types of credit spreads? For this video, I'm going to be covering just the main way to play a put spread and a call spread. So that is a vertical bullish credit put spread. So this is when you're selling puts when you believe the stock is going to go up. So you believe the stock is going to go up, or at least the stock is going to stay flat. So you're going to sell a strike at a price you believe the stock will finish above at the expiration that you choose. And a lot of times you're going to be doing this, in my opinion, with 2 to 3 days left on that expiration. So you're taking advantage of those Wall Street bet types people who think the stock's going to explode in the next 2 days. So this would be like a Wednesday. You would sell a Friday weekly option expiration. You're doing this to take advantage of that extreme theta decay. So let's say Wednesday, the stock is currently at $102, and you believe the stock's going to go up the rest of the week. You're bullish on it, right? So you would sell the $100 put option, and you would buy the 95 put option, thus capping your losses potentially. This makes a $5 strike spread. You potentially receive $200 for this, thus making your liability $300. You must maintain $500, which includes the $200 you receive, and then the additional $300 to cover that $5 spread. Thus, you must maintain $500 worth of cash to cover that. On the inverse side, let's talk about bearish call spreads, credit call spreads. So you believe the stock is going to go down or at least stay flat. So you see, for instance, like Max Payne or something in the market where you're like, all right, the market's going to not do anything. So like OPEX week or, monthly option expiration. So you're like, all right, there are so many calls expiring this Friday. The market makers are going to pin this below that. So you're like, yeah, I want to get advantage of that too. So you believe the stock is going to go down or at least stay flat. So you sell a call at the price you believe the stock will finish below. You then buy a call at a strike above that strike to complete the spread. So an example, stock price is currently $102. You sell a $105 call option and then buy a $110 call option to cap that. That makes a $5 credit spread. You receive, for example, $170 for this, and your liability is then $330. You must maintain $500 worth of cash to cover the spread until expiration. I have a few examples for you. So here's when I would consider potentially selling a put credit spread. So this is AZEK. This is a home builder materials stock. We've been getting a lot of bullish home builder data lately, and I see the stock. I see it's at breakout levels, and I see an inverse head and shoulders. So I say, all right, well, this stock could either go straight up and break out, or with the green path, or I see a red path where it could, go sideways, go down a little. Um, but I am still extremely bullish on this, and I think it's going to break out. So I'm looking at this, and I see, all right, my support's at 41. So I'm going to sell the 41 put and buy the 40 put, creating a $1 spread for whatever that would get me. Maybe it gets me $20, $30, right? And then I'm liable for $70. So I have a 1-2 risk, but the probability of me hitting this is very high. So this would be one example of when to sell put credit spread, is when something is near breakout, where you're not quite sure if it's going to break out, but you feel really good about it. And so you're going to do this because it may not break out right away, but you're pretty sure it's not going to go down. Example 2. This would be when something has sold off so much it's in a falling wedge, and then it breaks out and it retests that breakout, and it looks good to go back up. So in this example, this is C Unlimited. You see support at 200 and 210. So you're like, okay, worst case scenario, this is going to go down to 200, but should bounce there as well. So you could do two things. You could sell, if you want to take a higher risk one, you could sell the 210 and then buy the 200, or if you want to be super safe, you would sell the 200 and buy the 190. And you would do that maybe for this week, or if you're pretty sure this is the bottom, you could do this for a few weeks out to get a larger credit on it. And that would be one way to take advantage of a bullish scenario, by selling puts. So in a breakout reversal scenario or a potential breakout scenario are just two examples. The big thing to take away of this is you are very bullish on the stock. You are very sure it's either going to go sideways or go up, but this is the bottom, right? And that was when you would play put credit spreads. So let's talk about when you're going to play call credit spreads. This is a bearish scenario where you're very sure the stock is going to go down, or at least not up. So I just have Facebook here. This is an example of where I see a head and shoulders, and I see a rounding action, potentially a diamond forming on the right shoulder, with lower volume on the right shoulder as well, and some other indicators where I think this is going to go down, right? So you say, okay, I don't think this is going to go over 335. That's going to be my stop loss, right? So 335, you would sell the 335 call, and then you would buy the 340 call, thus creating a $5 spread, because at no point do you think it's going to get over 335. You think it's going to go fill that red gap down to 320, and that's your target on it, right? So that's one example of when you can sell put or sell call credit spreads. So because you're bearish on the stock, so you're going to sell calls and become the casino. Here's another example. You see a rising wedge on a stock that's near the top of the wedge. And so you say, all right, this is overbought. This is near the top of the wedge. This is near all-time highs. This thing should come down and consolidate, and I'm going to be bearish on this scenario. So you're looking at this and you see $44 as the top of the wedge. So you're going to sell the 44 call and maybe buy, if it has the 44.50 or even potentially the 45. So you're going to want to create a small spread, and you could do multiples of those. But the scenario is you would do that. Now, what happens if the stock continues to go up? Well, you could keep your 45 call, buy back your 44, and now you're in just normal calls. So that is one scenario. So let's say it continues to go down, then you're fine. But this is one thing where, like, let's say you're wrong and the stock continues to go, just buy back your sell piece, and now you're actually bullish on it. So instead of being bearish on it, you buy back the sell that you had, and now you have an uncovered call, and you can take advantage of that way up. And you can do the same thing with the puts. So let's say you think it's going to go up, but it all of a sudden starts to go down. You just buy back the leg that you sold, and now you have regular puts. You can take advantage of that to make up those losses. So the nice thing about the spreads is it gives you that versatility that you can do. Not all brokers allow you to do the single leg buys and sells, but some of the major ones should let you do that. Especially if you just sell it. If you do it as a ghetto spread, for example, this would be a way you could do that. So um, hopefully this video helped you understand credit spreads a little bit more. If not, leave a comment below and I can do a follow-up video as well. Thank you. Have a great day. And just so you know, if you enjoyed this video and you don't like it, it's possible a unicorn may die because you didn't like it. So just keep that in mind. There's a reason why we don't see them out there, and don't be that reason. Thank you, and have a great day.